Check, check, check. Okay. Hi, everybody. Hi, everybody, and welcome to another webinar of our series. Today, we're going to go down the path of technical analysis once again. More specifically, in this webinar, we will go over moving average convergence and divergence as a technical indicator. And at the end of the day, we're going to introduce some sort of strategies that you could deploy while using this insightful and very interesting technical indicator in order to make sure that you capitalize upon the information and possibly make money out of it. So for the time being, I see people joining in. Welcome, guys. And I think it's time to begin. Hopefully you can hear me loud and clear. You can see the first slide of the presentation. And you can type in the chat. Please let me know if you can contact me, or you can, let's just say, be able to just write out what kind of questions or queries you have in the chat box or in the Q&A. If none of those things work, just, I don't know, send me an emoji or whatever. Okay, so let's begin. So technical analysis, moving average, convergence, and divergence strategies. This is a quick risk warning and a disclaimer. The gist of it is that this information contained herein does not provide any investment advice or investment recommendation. Is for educational purposes only, and the redistribution of the material is strictly prohibited. Now that we go over this, let's get started. So technical analysis, two types. I've managed to spread it into two legs, if you would like. So we have charting analysis and mechanical analysis. Mechanical analysis is what you have in front of you as a plan, as an outlay. So we have on-chart indicators and off-chart indicators. As the name suggests, the category in the left-hand side goes on top of the chart, on top of price action, whereas off-chart, they are oscillators that are found on a separate window below the price action. Okay, so this is the main difference, even though they are all of them are technical indicators. So on chart, we have moving averages, Bollinger Bands, Ichimoku clouds, parabolic SAR, Fibonacci retracement tools, and all that kind of other stuff. These are not limited to, by the way. These are just mere examples of technical indicators that you could use on your charts. Off-chart indicators are in this kind of category, we have relative strength index oscillators in general. So moving average, convergence, and divergence, both of them unbound. Actually, moving average, convergence, divergence is unbound. RSI is bound between the levels of 0 and 100. So ADX is another one. Momentum is another one. All three, excluding the RSI, are unbound oscillators and indicators. So slight difference, but at the end of the day, you're going to see what information they convey and how important they are when you're judging whether to enter or exit the position. So moving average, convergence, and divergence, MACD is what we're going to deal with. Let's get straight to the point. So the MACD, this is a quick definition. So the moving average, convergence, and divergence is a trend following momentum indicator. Again, trend following. It's not trend leading. They're not giving you information about what's going to happen into the future. It's giving you information about what has already happened, because it uses moving averages. We said this many times in the past. So moving averages is a lagging indicator. It compiles information about what has happened in the past. It does not provide you with any clues about what's going to happen in the future. I'm not going to stop repeating this until you digest this. Okay, you have to keep this on the back of your mind. These are not crystal ball that predicts the future kind of indicators. They are merely confirming. They are used for confirmation only. Okay, so MACD is a trend following momentum indicator. Momentum, which gauges how fast price action is moving either to the upside or to the downside, depending on the closing prices or the average true range that has within the range of the prior days. We're going to talk about this soon. So it's a trend following momentum indicator that measures the relationship of two moving averages. So hence the moving average, convergence, and divergence. So it's used to spot changes in the strength, direction, momentum, duration of a trend of an instrument's price. So we're talking about three main categories or three main components here. Strength, how strong the price action or the move has been. The direction of the move is also given, but also momentum and duration. So four key pillars, not three. So Once added to the chart, this kind of indicator can be found on the bottom of the price action. Again, oscillator is a different window that goes below, which essentially measures the strength of the prevailing trend alongside with signals of the change of the trend. And these are key and subtle clues. It can also be plotted as a histogram, which moves above and below this baseline. You're going to see what baseline is, showing strength and weakness in price. Excuse me. Remember, in the last webinar we've done, we talked about moving average strategies, not moving average convergence and divergence strategies. So moving average strategies, the second example we had was using two moving averages, a small and a long moving average. So whenever you saw the small moving average crossing above the long-term moving average, that created a buy signal, and this is what gives us the confidence that we could go long, or we can buy that specific instrument, capitalize upon the shift in trend, which was possibly downwards or sideways. And now it has shifted to upside. Now, therefore, we take advantage of that. And remember, when you had the small moving average crossing below the long-term moving average, so SMA below LMA, that created a short signal, so a sell signal, which is completely the opposite, telling you in a sense that, you know what, yesterday's close was or today's close price was much higher compared to the average closes of the past X amount of periods. That gives us a signal that we have breached, in a sense, a key level, and now the bulls are in control and the price action is going to head to higher ground if and only if we see the small moving average crossing above the long-term moving average. The opposite case can be made. The short moving average, SMA, crossing below the LMA generates a sell signal, because today's close has breached the trading period or the average of the past 10 days, 12 days, 16 days, whatever that is. And now we are headed into new territory. The sellers are in control, and possibly we're going to see the price action falling lower than that in the immediate future. Okay, again, that's an extrapolation given the information that we have right in front of us. So it's a similar case with the moving average convergence and divergence. When I talked about earlier on about the histogram is the difference between this SMA and the LMA after a crossover. So the larger the histograms bars are, that means the faster the price appreciation is. So the wider the gap, the better it is for you if you go long. The opposite case can be true. So the baseline is the cutoff period between SMA and the LMA. So when you see these two lines crossing together, you're going to get a histogram value of 0. That baseline is indicating whether we shift from the bulls dominancy to the bears dominancy, etc. Okay, so it gives you direction of the trend, it gives you the strength of the trend, but also how strong or how fast the price actually is moving. In other words, momentum, but also duration. The MACD is used by all types of traders, such as position traders, swing traders, day traders, and more, since the indicator can be applied to any given time frame. For long-term or position traders, you look for that on the long term, so you get this as a confirmation signal that the position you have opened is going your way. Swing traders and day traders, they use this on a much shorter time frame. It's the nature of their trading methodology. So you may have much more subtle and quick and fast and sharp kind of pivots from from bulls to bears, taking the initiative. So you could take advantage of this by swing trading and day trading as well, using this kind of information for you to calibrate your entry and exit points much more accurately and sophisticated. Okay, something to remember: the MACD is based on moving averages. It's therefore a lagging indicator. And furthermore, the MACD is less useful when you have instruments that are not trending or are trading irrationally. Okay, so in a sideways price action where you see the price action being bound between two levels and not breaking either above or below, MACD is useless. So you need to have a trend in order for you to capitalize upon this kind of indicator with much more resolve, if you like. Okay. So the MACD, so the moving average convergence and divergence takes two trend following indicators, aka the 12 period and the 26 period. Now ask me about what's the period like. You could use 12 and 50, you could use 20 and 30, whatever that is. You need to have a small and a long-term moving average, or in better cases, you can have exponential moving average, not a simple one. But at the end of the day, you need two moving averages to see the crossovers between the two, which are indicating the shifting trend. MACD uses that information, but it also gives you an idea of how strong the move is, how fast the move is, how long it's going to take or has taken. So these are also other key insightful data that you could look upon. Okay, so in terms of these two moving averages, the 26 and the 12, which are based on commodities life cycle kind of scheme, if you will like. They have some sort of correlation. These values that you use for EMAs with futures contracts ending, but also commodity cycles. That's why you use 12 and 26. And you take these two moving averages and you turn them into momentum oscillator by subtracting, excuse me, the EMA, the short EMA from the long one. Okay, so the difference between the two gives you the moving average line, the MACD line. Okay, so when the MACD line crosses above zero, it signals positive momentum and that the bulls are in control. And when the bears are actually taking the initiative, you're going to see MACD line crossing below zero, which is going to signal negative momentum and the bears are in control. Okay, indicates negative momentum. You get the point. So the trigger or the signal line is a 9-period EMA of the MACD. You're going to talk about signal soon. So it crossovers between the trigger line and the MACD line are used in a similar fashion, much like crossovers between two moving averages. Okay, so MACD line and signal line, you can imagine them as a the short moving average and the long-term moving average crossing between each other. Okay, and this is going to give you what's going to give you a baseline value of zero when you have crossover between the MACD line and the signal line. Okay, so a trigger line. Yeah, we talked about this. This is also a visual illustration of the MACD moving average convergence and divergence below the chart, but you also see another aspect of things which we're going to talk about, which is divergence. So convergence means the things are price action is aligning, or much more accurately, the MACD indicator is aligning or it's moving or it's having the same pattern as the price action. Is not always the case. So when you have convergence, that's good. You have confirmation that the price action is moving to a desirable direction. You have the direction in place, you checked. But the key and interesting part of the moving average convergence and divergence as an indicator is the divergence aspect of things, where you have the price action doing one thing and the MACD telling you a different thing. Okay, so it indicates a different thing, not about price action, but more specifically about momentum. So price action maybe continue to make higher highs and higher lows. Okay, so climbing constantly, but MACD below your chart is not confirming that. So you have lower peaks and lower troughs, and you can see and you can spot the momentum waning out. So yes, we might see the price action heading to high ground, but the how quickly it does it, or how with much more resolve is it doing it, is going to be signaled, or is it going to be given by the momentum which is below. So if you see a divergence between the price action and the MACD, so indication of a loss of the acceleration of the trend or a slowdown of the trend of the price action or the momentum, much more specifically in this kind of case, you can use that as a valuable signal to await for a possible reversal, and you can play the opposite side, because you assume that momentum and volume kind of precedes price, which may not be the case most of the times. Price precedes pretty much everything, but momentum is also a key useful indicator for you to exit or enter a position much more quicker before the price action does. Okay, so it gives you a different point of view, alternative point of view of momentum, which is not being given by the price action purely. If you look at price action, if you look at price action, it's going to be making new highs, excuse me, higher highs and higher lows. But for some reason, momentum is thinning out. You cannot see that if you don't have the MACD indicator below your chart or a momentum indicator below your chart. So it serves as a premonition that, you know what, you need to pay attention. You need to safeguard your bottom, because reversal is at bay. The bears are creating momentum if the price action is headed to high ground, and they're going to take the initiative soon, and you're going to see a plummeting of price action. Okay, so it gives you heads up. Okay, only if after this has happened. Okay, excuse me. So in this slide, we're going to look at the main components or the basic components of the MACD. We discussed this briefly, but let's go into detail. So indicator shows a blue line, a red line, and a histogram bar or a bar chart, which calculates the difference between the two lines. So the difference between the blue line and the red line, the MACD and the signal line, is the creation of the histogram. Okay, so the further away the MACD line is from the signal line, the larger bars you're going to have, assuming that the MACD is above the signal line. And the opposite case can be said here. So you have a crossover between the MACD line and the signal line, and you see the MACD line crossing below the signal line and falling. Okay, that indicates the bears are in control, and most likely you're going to see the histogram bar. Not most likely, definitely you're going to see the histogram bars of the MACD turning negative, turning red. Okay, signals that the bears are in control. Okay, so for example, this line means the MACD line is the blue line, which is the difference between the 26 and the 12 period EMAs. Signal line is just a simple moving average or exponential moving average of 9 periods. Okay, so with 9 periods of the MACD. Okay, so the two averages. So the signal line is the average 9-day moving average of the MACD. So you first to calculate the MACD, you have to take the 26 and the 12, you get the difference, that is the MACD, and then you have the exponential moving average of the MACD, which is the signal line. Okay, so you use these two as moving averages. One is short and one is long. So histogram bar is the difference between the blue line and the red line we just discussed. So the period for the moving averages on which the MACD is based can vary, but most commonly used parameters involve a faster EMA period of 12 and a slower of 26. Excuse me, I didn't have my coffee yet. And the signal line as a 9-period moving average of the MACD, or the difference between the 26 and the 12. Okay, so in the written form, you can find the MACD is the faster. So 12, 26, and 9 is a way to discuss and talk with other people on what kind of settings you have for your MACD. 12, 26, and 9. But yeah, that's it. So a visual illustration. What do we have here? Let me get my pen or laser pointer or whatever that is. Let's look for first crossovers. Okay, so you have the traditional moving average periods, so 26 and the 12. So this is the thing we discussed in the prior webinar, using two moving average strategies in order to have buy and sell signals. So crossovers are what we care about. You have one here, maybe one here, clearer, much here, another one here, another one right here, and here another one. Okay, so you can compare and contrast by using only two moving average strategies, the short and the long, but also the other scenario we're going to have this and the MACD below. You see which one has a much more accurate kind of signal. Okay, so the crossover between this is going to happen here. As you can see, crossover happen here, here, another one here, here, another one, and another one, and another one, like DJ Khaled guy, whatever. Anyway, so what you can, as from an observational point of view, if you don't know anything about MACD, what kind of conclusions you can come up to when you look at purely this. Okay, so first and foremost, when you see a crossover between the blue line, which is the MACD line, which is again the difference between these two, the 12 and the 26, okay, with the signal line, which is the exponential moving average 9 period of the MACD. Okay, what do you see? Okay, whenever you see crossovers, you see the zero line, the baseline, or the histogram kind of flattening. Another crossover here, another crossover there, another one here, 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 here. Okay, so as you can see, when you see the MACD line crossing, having crossover with the signal line, the blue line with the red line, baseline is 0. So the histogram is 0. This is the pivot point. Okay, this is what we care about. That means the momentum of the bulls or the bears has waned and the other party is in control. Okay, this is what we do care about. So also, what else do you need? Do you see when you see the MACD line crossing above, the blue line crossing above the threshold, the baseline? Okay, this is what generates the buy signal. That means the bulls are in control. this is the confirmation, and you can see clearly it's going to align with the actual crossover between the two. Okay, moving average, the simple moving average of 12 and 26 we have above on price action. Okay, same thing can be seen here. Blue line crosses the zero line. Bulls are in control, complete alignment. Okay, same thing can be in here. Blue line crosses below in this kind of case. This generates a sell signal. So this is a sell. That's one way of looking at it. There's many ways to use moving average strategies, by the way, with MACD, excuse me. This is a buy signal. Again, the blue line crossing below generates a sell signal, and we are excluding job patterns or formation of other price action. Okay. Whenever you see another one was here. Okay. So the signals are generated when the when the MACD line crosses either above or below the midline or the baseline or the zero line, this one. Okay. The buy and the sell signals are generated here. The crossovers are indicating the shift in momentum. Okay. And again, blue line crossover below, either above or below, confirms that the trend has shifted and the bulls are in control, or the bears are in control in this kind of case, and generates the sell signal. So after the transition has already happened, but the early signal that the shift in momentum has taken place is given by the difference between moving average, the MACD as a line, and the signal line. Okay, so here in this kind of point, this was an early indication in this area that the bears have already taken control of the price action. They have zeroed in, they have eliminated the momentum of the bulls, and now they are shifting the momentum towards their side. Okay, they're not in control yet, but the momentum has shifted. This is what the blue line and the red line crossovers are telling you. Okay, so in this kind of case, we had the signal up here that the bears have or are already taking the initiative, and possibly we're going to get a generated sell signal afterwards after we see the blue line crossing below. Okay, so that's how you use this kind of information. Same thing can be seen here. Zero line of the negative momentum by the bulls. So the blue line crossed over below above the red line generates a signal that, you know what, raise a flag that, you know what, the bulls are fighting back and they are zeroing in, or they are containing the bearish momentum. So pay attention to this. But the definitive signal came down here when you had a complete or clear crossover of the two, of the blue line with the red line, indicating shift in momentum. My days, terrible handwriting. This is an M. And this is an O. I'm making it worse. Never mind. This is, yeah, never mind. So it's a shift in momentum is generated by the MACD and the crossover of the MACD and the signal line. And whenever you see a crossover of the MACD line, the blue line, just the blue line above the moving average, but also the confirmation that the signal line is heading that way as well, this generates a buy signal. Okay, or a sell signal, depending if it's up crossing above or below. The larger the histogram bars are, the better it is, because it gives you an idea that the momentum between the two is widening. So the less dominancy the bears have, the more the bulls have, the wider the gap is going to be, and vice versa. So it's going to be reflected by histogram bars. If they are large and larger than compared to prior times, super good news for you that if you have entered the position hereby. Okay, so the crossover in this kind of case between a shifting momentum occurred somewhere in here. So the signal was here, the confirmation came after. Okay. So you may ask yourself now, which one shall I be trading upon? Shall I be opening positions right when the signal, when you see crossovers of the signal of the moving average line, MACD line and the signal line? Is this my entry point? Yes, it could be, but remember, you have seen this kind of fake out taking place here as well. So yes, maybe partially open a position with the signal and add on to your position after you get the confirmation, or you go straight to the point and just buy whenever you see a crossover appear and the MACD line crossing above or below the baseline. Okay, this is the safe option, if you will like, and this is pretty much a rushed kind of way. So if you pay close attention to, and if you deal with the MACD as an indicator on a daily basis, you can spot these quite easily, and develop a strategy depending on your needs and your risk tolerance accordingly, whether to buy or enter. Maybe you would like to see the signal and the confirmation and then buy the thing, or maybe you just jump straight through and play only the crossovers and go long and expect the signal to come, the actual sign, buy sign to come later on and get the confirmation or exit the position there. Depends how you approach this kind of thing. Okay, so let's move on to the next slide. So interpreting the MACD is probably going to be a summary of what has already been said by me right now. So exponential moving averages highlight recent changes in a trading instrument's price. Delete this. Okay, so the exponential moving average highlight recent changes in trading instruments price by comparing EMAs of different lengths. That's the whole point. MACD line gauges the change in trend of an instrument. Okay. By then comparing the differences, the change of that line to an average, analysts can identify subtle shifts in the strength and direction of an instrument's trend. Okay, this is what the MACD and the signal line give you. So traders recognize three meaningful signals generated by the MACD indicator. When the MACD line crosses the signal line, remember, this is what I'm talking about here. Okay, when the MACD, which gives you, in a sense, the first signal, this is the definitive, if you would like, and this is in big quotes, signal generation. Okay. And whether there is divergence between the MACD line and between the histogram. Okay, so higher highs and higher lows. Okay, for example, in this kind of case, you see waning momentum, even though the bulls are in control. Clear break above the line, so positive histogram bars. Price action may have looked something like this. Okay, or if there is actual divergence, maybe it's going to be like this. Okay, so yes, higher low, it's a higher low, higher low, higher high, higher high, higher low. Okay, lower high, excuse me, in this kind of case by new high. So the signals that momentum is waning out. Okay, so pay attention to this because the bears are fighting back. They are decreasing the strength of the bulls in this kind of case. So graphically, this corresponds to, if we're talking about the first point, the red line crossing the histogram. Okay, the MACD line crossing below there, the blue line crossing the x-axis, straight back line in the middle of the indicator, and the lower highs, higher lows. Okay, the price graph, but not on the red line. The higher lows or high highs on the price graph, but not on the histogram graph. So you compare the histogram with the price action. If the price action is making higher highs and higher lows, whereas the histogram does not do that, this is what we call a divergence. Okay, because this one moves upwards, this one moves downwards. Maybe after that, we're going to see something like this. okay? Because the bears are steadily, okay, pushing the brakes on the bulls kind of dominancy. And at some point in time, when the bulls leave the picture and the only thing is going to be left is bears, you're going to get some sort of volatile move to the downside because they're going to take the initiative. Okay, so signal line crossover, if not the most, one of the most important aspects. Signal line crossovers are the primary cues. And excuse me, this is not a signal. I'm going to call it a cue in order for us to have a much more equal framework of talking about things. Okay, so the standard interpretation is to buy when the MACD line crosses up the signal line. So this is the blue and this is the red. Okay, or sell when it crosses down through the signal line. Okay, so the blue line is larger than the red line, or the value of the blue line is larger than the red line. The value of the blue line is the MACD, the value of the red line is the signal line. Okay, if it's above, this gives you a buy signal, and the opposite is also true, vice versa. The upwards move is called a bullish crossover. This is the bullish crossover, and the downwards move is called a bearish crossover or the death crossover. Okay, so respectively, they indicate that the trend of the instrument is about to accelerate in the direction of a crossover, not a shifting trend. And the histogram shows when a crossing occurs. Okay, as we said, when you see a blue line crossing the red line, histogram bars are going to be 0 because it indicates the shift in an instrument's direction. Okay, this is what the crossover is telling you. Since the histogram is the difference between the MACD line and the signal line, when they cross, there is no difference between them. So the histogram can also help in visualizing when two lines are approaching to cross over. Okay, so in this kind of case, this is where a crossover you're going to be seen from the MACD line, and the signal is going to be shown from the MACD indicator. This is a MACD indicator, not adjusted, unfortunately, or modified from not trading view, from MT4. So you can see this exactly the same thing. So when the signal line crosses below, the MACD line crosses below, you're going to get the bears signal that the bears are going to be in control, and the narrowing or the flattening out of the histogram bars tell you that it's going to be a crossover. Okay. So although it may not show a difference, changing size of the difference can indicate an acceleration of the trend. So the larger the histogram bars are, that means the further away the MACD line is moving away from the signal line. That gives you an indication that there is enough bullish momentum or bearish momentum, depending whether it's up or down. Okay, so a narrowing histogram suggests a crossover may be approaching, and a widening histogram suggests that ongoing trend is likely to get even stronger. Wider the gap or the larger the histogram bars gives you extra confirmation that the faster the pace of the price action is going to move to. Okay, so again, this has been a super simple interpretation of what to expect from using the moving average, convergence, and divergence as a technical indicator onto your chart. Hopefully this visual illustration has broken down the basic components and give you an understanding on how to decipher this kind of information that is given. Hopefully this has been informative. If you guys have any sort of questions, please let me know in the chat or the Q&A. If not, we're going to close this session short. But yeah, the MACD as an indicator is super helpful. I like to use it on a day-to-day basis when I conduct my trading activities. But yeah, there is a version or a new adaptation called MACD-V, which also gauges the volatility. It was created by a guy named Alex Piroglu, who is a super interesting guy and has won 2 awards, if I'm not mistaken, from bringing forth this kind of new modified adopted point of view of using the MACD indicator. Again, super insightful. Hopefully we're going to do a webinar on MACD-V or in the near future, kind of adding on to our lessons, if you would like, from this kind of webinar, and hopefully getting more information and more value or insights or cues on how to use the MACD as an indicator to our advantage and capitalize upon this. But yeah, there are a lot of new adaptations. MACD was the latest one I've saw, and I said, okay, this is super interesting. Let's put it into question and see what and how it can be useful to our journey. Okay, so as I can see, there's no questions in the Q&A or the chat section. I'm going to close this session short, guys. Thanks for watching, and hopefully we're going to catch you on to the next webinar of our series. For the time being, take care. Bye-bye. Have a lovely, lovely weekend. And again, trade hopefully safely. Take care. Ciao. Bye-bye.